Chapter 3. Expenses Matter. Beware of little expenses. A small leak will sink a great ship. Benjamin Franklin. Mr. Talwar's expensive investment products. Mr. Talwar was a broker's delight as he primarily focused on gross returns, be it returns from stocks or the long term returns that his unit linked insurance plans promised. Gross return is not a true reflection of a portfolio's performance because it is inclusive of funds managers and brokers' fees. Investors should instead look at net returns, that is, net of the fund managers and brokers' fees and commissions. Had Mr. Talwar looked at his portfolio more keenly, he would have realized that his basic purpose of investing money was being defeated by a very high expenses. At 1% or more brokerage or fees per transaction, and due to the frequent churn, he ended up paying up to 7% per annum of his stock portfolio as commissions. ULIPs were even worse. They have three components: insurance, investment, and expenses, and their tenors run into decades. However, what Mr. Talwar did not realize was that he would end up paying up to 60% of his first year premium as fees. Such a high fee significantly reduces the principal left for actual investments. This is like starting a run chase in a 1 day cricket match with 4 wickets down. Obviously, the impact is huge but is camouflaged by the complexity of this multi decadal product. Expenses, expenses, and more expenses. In the investment world, there are primarily three types of expenses that the investor, knowingly or unknowingly, pays for. First, transaction fees, also called brokerage. It is a fees you end up paying every time you enter a transaction. More typical to the stock portfolio, these expenses look small in themselves. However, they have a devastating effect when the portfolio turnover or the churn goes up. If a broker charges you a 0.5% fee for a stock purchase, it may not seem like much. If, however, in the course of a year you bought and sold 5 times, your total fees as a percentage of your portfolio becomes 5%. Number 2, annual fees. This is more typical of funds like mutual funds and PMS, wherein the fund manager charges an annual fee which can actually be paid on a monthly or quarterly basis as well. Additionally, there may be a performance fee which as well where the fund manager is entitled to a share of the profit that he is able to generate for investors. The performance fee is typically settled annually. Number 3, hidden fees. In insurance products and structured products, it is not easy for investors to understand exactly what fees are being charged. In structural products, for example, the investor could be given a formula for the return on his principal, but that is really the net return in his hands. He is not told what the actual gross return generated from the product is. The difference between the two is what the manufacturer and the distributor cream from the buyers of structured products. Such hidden charges are also embedded in complex products like ULIPs. Most literature on finance is about investing money wisely to generate stellar returns. As a result, investors tend to focus largely on gross returns without realizing that high expenses can be just as damaging to their long term financial health as weak returns. The financial services industry realizes that expenses are a blind spot for most investors, and hence, clever brokers and intermediaries have created different ways to skim investors. In this chapter, we highlight investment methods that minimize expenses. Fund expenses compound too. Most of us invest in the market through the managed fund route. These could be mutual funds, PMS, or AIFs. While these are different types of investment structure, they are more or less similar as they pool investors' money and then nominate a fund manager to manage the corpus. The investor pays certain expenses for this fund management as well as other operational expenses. In Chapter 2, we mentioned the power of compounding. Unfortunately, for investors, expenses too can compound over time. As an illustration, let us compare two mutual funds with the same gross return of 15% per annum. The first has an expense ratio of 2.5% per annum, while the second has an expense ratio of 0.1% per annum. Let us now see the impact of these expense ratios on the long term returns generated from investing 1 lakh rupees in each of these mutual funds. See exhibit below. Exhibit 19. Expenses dragged down returns significantly. Initial corpus of rupees 1 lakh. The second fund's corpus exceeds that of the first fund by 24% after 10 years, 53% after 20 years, 89% after 30 years, and 133% after 40 years. A 20-year-old who invests 1 lakh rupees when he or she starts working will get 1.1 crore when they retire at 60 from the first fund, which has a 2.5% expense ratio. From the second fund, which has a 0.1% expense ratio, he or she will get rupees 2.58 crore. That's more than double the corpus from the first fund. These are not assumptions which we have plucked from thin air. Presently, most equity mutual funds have an annual management fees of 2.5%. In contrast, in an ETF, the fee is approximately 0.1%. Most investors tend to focus on gross returns alone, and as a result, they chase the best performing mutual fund. In doing so, they forget that performance is not guaranteed. It can go up and down, but the expenses are bound to be charged. Apart from death and taxes, you can now add expenses as the only certainty in life. Given the effect of these expenses over long periods of time, they often become the single biggest driver of returns, especially in a world where fund managers with broadly similar capabilities and similar access to information are slugging it out daily in the stock market. Past, present, and future. Like all other industries, the portfolio management industry has also evolved over the past 100 years. The industry grew rapidly in the US in the early part of the 20th century and in India in the 1990s. In the pioneering era, the excellence did not matter. Almost all fund managers outperformed the index in those days. However, with the rising competition and greater regulatory oversight, first in developed markets and now in India over the last 10 years, it has become much harder for Indian mutual fund managers to generate outperformance. They squeeze the profit margins for the mutual funds and for their distributors. That in turn brought modern technology to the forefront as enterprising fund houses started using algorithms to run funds at very low cost. We cover this transformation in the industry through three central themes. Number one, the alpha squeeze in actively managed funds. Number two, the introduction of inexpensive fund options and direct schemes in mutual funds. And number three, the advisory led offering versus the distribution led offering. But first, a little bit of history. Evolution of mutual funds. A mutual fund, by definition, is an investment vehicle made by collecting funds from various investors for the purpose of investing in assets like stocks, bonds, etc. Such funds are managed by an expert manager who seeks to provide returns or gains to the investors. Mutual funds are believed to have originated in Netherlands in 1774. A Dutch merchant named Adriaan van Ketwich pooled money from a number of subscribers to form an investment pool and named it Endracht Markt, which means unity creates strength. By early 1775, the fund was fully subscribed and the share became tradable on the Amsterdam Exchange. Ketwich's model of funds pooling gained popularity across Europe through the 1800s and eventually reached America. These early mutual funds were mainly close ended and issued only a fixed number of securities. The first modern day mutual fund, Massachusetts Investor Trust, was created in the United States in 1924. It was an open ended mutual fund and allowed for a continuous issue and redemption of shares. By the end of 1929, there were about 20 open ended mutual funds and more than 500 closed ended mutual funds in the US. The mutual fund industry in India was born in 1963 when the Unit Trust of India UTI was formed through an act of parliament. For almost 25 years, the UTI was the only entity offering mutual funds in India, and the first scheme it launched was Unit Scheme 1964. In the 1970s and 1980s, the UTI launched many more products to cater to various investment needs. By the end of 1987, it was managing approximately 6,700 crore rupees in assets under management. In 1987, for the first time, non UTI public sector entities were permitted to enter the industry, and this marked the entrance of various other public sector entities like State Bank of India, Canara Bank, Punjab National Bank, LIC, and GIC. By 1993, the total industry assets under management were close to 50,000 crore rupees. The year 1993 marked the entry of private sector companies in this sector. Kothari pioneer, now Franklin Templeton, was the first private sector mutual fund to be registered in 1993. The number of mutual funds registered with SEBI kept increasing through the 1990s, with many foreign mutual funds setting up shop in India. By the end of 2003, there were more than 30 mutual fund houses with more than 1 lakh crore rupees worth of assets under management. The Indian mutual fund industry now has more than 40 fund houses offering approximately 2,500 schemes across various asset classes like equity, debt, hybrid, and commodities, gold. The industry now manages more than 20 lakh crore rupees, that is 20 trillion rupees, approximately 315 billion US dollars in AUM, which about 6 lakh crore is in equity. Over the past 18 years, over the past 18 years, the industry's total assets under management have grown at 19.4% per annum, whereas total equity assets under management have grown at 17.7% per annum. The tax efficiency of the product mutual fund investment enjoy tax benefits that they are eligible for taxation at concessional rates. The growth of the distribution industry, wherein third parties like banks, brokerages, and financial advisors can sell mutual funds, and the continual rise in India's national income have been the key drivers of this stellar growth. Exhibit 20: The Evolution of Mutual Funds in India. The early years of mutual fund, an era of high expenses. Fund expenses are the financial cost of investing in a fund. Typically, there are three types of costs that investors have to bear: entry load, exit load, and recurring expenses. Recurring expenses Recurring expenses include the fund management fee and various other operational costs like broking, custody, fund accounting, compliance, and marketing fee. Entry and exit loads are the additional expenses that funds can charge the investors. A decade ago, mutual funds used to charge 2.25% as upfront fee or entry loads. While SEBI has abolished entry loads in mutual funds, exit loads are still being charged. Most of the equity funds charge a 1% exit load if investors redeem in less than a year. The American mutual fund industry is around 40 years older than ours and hence both mature and more competitive. In the US, fund management fees have come down significantly. In fact, as shown in Exhibit 21, total expenses in the US expressed as a percentage of assets under management have fallen cumulatively by 40% in the last 2 decades, left axis of the chart. In contrast, in India, expenses continue to be high, that is right axis of the chart. Apart from SEBI abolishing the upfront fee, it would appear that little has changed with respect to the fund management charges. Exhibit 21: Equity mutual fund expenses in the US and India. Part of the reason why expenses have remained high in India is that so far it has been easy for the funds to get away with high expenses. Funds have managed to generate significant outperformance in India, especially in bull markets, which has meant high returns, net of fees for the investors. For example, between July 2003 and January 2008, the leading mutual funds in India gave compounded annualized returns of 58% compared to 48% from Sensex. Those years were the golden period of mutual funds as well as the distribution industry. Reminiscing about that era, a veteran private banker told us money was pouring in from everywhere. The funds used to charge 2.25% as upfront expense, all of which went straight to the distributors, who sold those funds to investors. There was also an exit load. With the markets moving up on almost a daily basis, relationship managers were churning portfolios like mad, citing profit booking as a ground for moving investors from one fund to another. They were earning as much as 5 to 10% annually from the upfront commissions alone. Another veteran private banker who has fond memories of the 2003 to 2008 era, we were on a roll. Every 3 months, a mutual fund or the other used to take our sales team to the foreign locations. I personally saw at least 15 different countries thanks to them. These trips were lavish and no expenses were spared to indulge the distribution team. This, in turn, was driving the sales behavior. Such lavish entertainment for mutual fund distributors is still the norm. Exhibit 22 shows two such contests recently hosted by manufacturers to incentivize their distributors to sell more. The more they sell, the nicer their all expense paid holidays. Exhibit 22. Mutual fund houses offer distributors a range of incentives. In India, as in the other parts of the world, the distribution industry has evolved along the mutual fund industry. Each side needs the other. With the low levels of investor education and awareness, only 5% of household assets are invested in financial assets. See Exhibit 23. For the fund manufacturer, it is not enough to just have a good fund in place. It is critical to reach out and push people to invest, and that's where the distributors come into picture. Since most mutual fund houses do not want to invest in large in-house sales team, they remain dependent on their distributors to reach out to investors. Exhibit 23. Allocation of household assets in India shows dismal holding in financial assets. Real estate 77%, durable goods 7%, gold 11%, and financial assets 5%. As shared earlier, a distributor is a broker who sells a mutual fund scheme to the investor and gets commission from the fund house in return. These commissions come in two forms, upfront and annual. In 2009, the SEBI banned upfront commissions, which used to be entire entry load of 2.25%, which was collected by the fund house and passed on to the distributors. The annual commission or trail in industry jargon was and remains typically at 1%. The biggest distributors are the banks, both multinational and Indian, which use their branch networks as staggering grounds to push investment products. If you visit the branch of a typical private sector bank on a Saturday afternoon, you will see dozens of investors being subjected to sales pitches from their relationship managers, whose bonus depends on persuading the investor to buy the product. Over time, however, a second category of equity funds with lower expenses have emerged. These funds do not need a fund manager and thus do not incur fancy fund management charges. These funds are called passive funds. Active versus passive funds. An expense borne by the fund house is ultimately a fee that you, as an investor, will pay. To a consumer of service, as long as the service is making sense, the expenses are not a problem. In the case of mutual funds, the service is the outperformance that the fund manager is able to generate for you. Note that our focus is on outperformance and not just the performance of the fund. Outperformance, which is also called alpha, is the incremental performance that the fund manager generates vis-a-vis a benchmark such as the Nifty or the Sensex. There are ETFs or exchange traded funds which fully replicate a benchmark. For example, a Nifty ETF is a fund that invests in all the Nifty 50 companies in the same proportion as they are in the index. This ensures that the value of the fund moves exactly like Nifty. ETFs, as a rule, have very minimal expense ratios since they do not offer active fund management and hence do not have to employ highly paid fund managers. An ETF is almost like a technology platform. Since an ETF does not have to pay a fund manager, it is able to charge fees which are lower than actively managed funds. Most index ETFs today charge fees ranging from 0.05 to 0.15%, whereas most active equity funds in India charge in excess of 2%. In an actively managed fund, a fund manager manages the money using his judgment and discretion and thus charge a fee. At the other end, passively managed funds have no input from a human manager. Passively managed funds come in two types. Number one, funds with brains and funds without. In the former, also called smart beta funds, the fund is run based on a preset strategy or an algorithm. For example, there are mutual funds which invest in a mix of Nifty and government bonds. The weightage of each asset class is determined by the price to earning ratio of the Nifty. In other words, based on an allocation table, the fund invests more in the Nifty when markets are cheap and less when markets are expensive. Since the decision making is based on a predetermined formula, there is little contribution from the fund manager except executing the trade. The second category of passively managed funds is index fund, just like index ETFs. They are simply built to replicate an index like the Nifty or the Sensex and have minimal human inputs. In every country, the fund management industry starts with actively managed funds. Then, as that market becomes more competitive, more perfect, it first becomes more difficult and then almost impossible for funds to outperform the broader market. That is when passively managed funds, then ETFs with low expenses, start gaining market share. Let us understand what a perfect market is. A perfect market, it is all in the price. In a perfect market, all buyers and sellers have exactly the same information. There is no information asymmetry, or in other words, there is nothing that one single market participant knows which others do not know. Information is power in an imperfect market, and if you know something about a stock, example sales number or in this quarter or before anybody else, you can trade if favorably in that stock before that information is known to everyone else. Then, once that piece of information is available to everybody else, the stock will move in the direction that favors you. The perfect market assumes that all available information is reflected in the stock price. Sure, company XYZ has lowered its revenue projection over the next few quarters, but everybody knows that. The stock has already been sold to the extent to absorb that information. Sure, company LMN has hit upon a new plant and has a rosy picture of the future, but again, it has been bought enough by the market participants, and the price already reflects that. No market can be absolutely perfect or imperfect, but the developed markets in the US and Europe are nearly there after over 2 centuries of evolution. As a result, in these markets, actively managed funds have no edge over index. As a result, in these markets, actively managed funds have no edge over index ETFs. According to Morningstar's July 2017 report, only 10 to 20% of active US equity funds beat their benchmark over the 10-year period ending December 2016. India is an example of a market that is moving in the direction of the American and European markets. There is still information asymmetry but is reducing gradually from massive outperformance a decade ago. Actively managed funds in India struggle to eke out meaningful performance today, and even that little bit of outperformance is under threat as SEBI, the market regulator, ramps up its vigilance. To be more specific, the Indian market regulator now has sharper teeth compared to the pre SEBI era where stock manipulation was rampant. According to Pawan Agarwal, a veteran stockbroker, the nexus of the brokers had its heydays in the late 1990s and early 2000s. Money was being made and lost by rigging up prices all the way up and then down, while brokers in cahoots with promoters were making a lot of money. Innocent investors were burning their hands. These shady practices are one of the reasons why stock market investing never took off among Indian retail investors. The alpha squeeze in Indian mutual funds. Ambit Capital has developed a deep to identify the outperformance or alpha that the large cap equity mutual funds have generated in the past. To test the hypothesis of whether alpha in India has fallen over time, as it did in the West, we divided the performance across two time periods: the long past, that is 1991 to 2009, and the recent past, that is 2010 to 2017. Exhibit 24 shows the outperformance of the large cap equity funds between January 1991 and December 2009. Large cap funds have given meaningful outperformance in this period. On a median basis, there is an alpha of 4.7% per annum in the 5 year and 1.1% per annum in the 10-year rolling periods. Exhibit 24, Large Cap Equity Mutual Fund Opportunities between January 1991 and December 2009. However, when we did the same exercise for the period January 2010 to February 2017, the script changed dramatically. In the 7 year period, there is hardly any alpha left. Given that the index does not carry the effect of dividend returns, actively managed large cap equity funds in India have actually underperformed the index between 2010 and 2017. So there is actually a negative alpha. Exhibit 25, Large Cap Equity Mutual Fund Outperformance between Jan 2010 and August 27. The more visual representation of alpha squeeze is shown in Exhibit 26. Exhibit 26, Alpha of average large cap mutual fund performance over Nifty Total Return Index. We can almost hear those championing the cause of active large cap equity fund management saying, even if large cap equity mutual funds as an asset class cannot deliver alpha, surely there are a handful of truly great fund managers who can. Let's focus on giving them money to manage. Unfortunately, even this argument does not hold true.